Fractal reversal divergence is a specific trading technique. It is designed to help traders identify potential trend changes. This method involves analyzing price action closely. It also requires looking at technical indicators carefully. The core idea is to find disagreements. These disagreements between price and an indicator are crucial. They often signal that a price reversal might occur soon. This technique is rooted in the fractal nature of financial markets. Markets often exhibit fractal characteristics. This means that similar patterns tend to repeat themselves. These patterns appear across various scales. You can see them on very short-term charts. You can also observe them on long-term charts. Price movements inherently show these fractal qualities. Fractal reversal divergence builds upon this fundamental observation. It aims to pinpoint market turning points. The goal is to do this with greater precision than simpler methods might allow. Before we explore fractal aspects more deeply, let us review simple divergence. Simple divergence is a foundational concept in technical analysis. Many market technicians rely on it. It occurs when the price of an asset and a technical indicator move in opposite directions. This is a clear sign of disagreement. Such situations frequently arise near significant market tops. They also often appear near important market bottoms. Think of it as an early warning. The market might be preparing for a shift. There are two primary types of simple divergence. The first type is known as bullish divergence. This pattern typically forms during a downtrend. Price action records a new lower low. However, the accompanying oscillator or indicator forms a higher low. This pattern suggests that selling pressure is starting to diminish. The downward momentum is waning. A potential upward reversal in price could be on the horizon. This is a signal for potential buyers to become alert and watch for confirmation. The second type is bearish divergence. This pattern occurs at potential market tops, usually during an uptrend. The price of the asset makes a new higher high, but the indicator fails to confirm this strength. Instead, the indicator registers a lower high. This pattern indicates that the buying momentum is fading. The upward thrust is losing its power. A potential downward reversal might be approaching. This could be an important signal for those considering selling or shorting. Simple divergence is undoubtedly a powerful tool. Many traders incorporate it into their strategies. They often use it with momentum oscillators. Popular choices include the Relative Strength Index, RSI. The Moving Average Convergence Divergence, MACD, is also frequently used. Divergence helps traders to anticipate potential trend changes. However, it is important to note that divergence alone can sometimes produce false signals. This is where considering the fractal nature of markets can add significant value and refinement to the analysis. The idea of divergent price territory, often abbreviated as DPT, is crucial. It is not enough to simply spot any instance of divergence. The location where that divergence occurs matters immensely. DPT refers to specific pre-identified price zones on a chart. Divergent signals that form within these particular zones carry more weight. They are considered more significant. These zones often coincide with established support levels, or they may align with known resistance levels, adding to their importance. Identifying these divergent price territories involves careful study. Traders must examine historical price action. Where have prices reversed significantly in the past? Are there strong, well-tested support areas visible on the chart? Are there formidable resistance areas that have previously capped rallies? When a divergence signal materializes within these predefined zones, its potential reliability increases substantially. It is like finding a crucial piece of evidence and finding it at a location already known for similar past events. For instance, let us consider a bullish divergence signal. Suppose this signal appears on the chart, and it forms near a major historical support level. This makes the signal much stronger. The support level itself inherently suggests potential buying interest. The bullish divergence then confirms that selling pressure is weakening. This combination of factors offers a trade setup with a higher probability of success. It is an example of signal confluence which many traders seek. Consequently, traders who utilize fractal reversal divergence often proactively map out DPTs. They mark these zones on their charts. They do this even before they begin to look for actual divergent signals. This methodical and proactive approach serves a valuable purpose. It helps to filter out much of the market noise. It allows traders to concentrate their attention. They can focus on areas where reversals have a higher statistical likelihood of occurring. This adds a layer of location-based confirmation to their trading decisions. Multi-time frame analysis, commonly referred to as MTFA, is very important. It is a technique that should not be overlooked. MTFA means examining price charts of different time periods. For example, a trader might analyze a daily chart. Then they would also look at a 4-hour chart and perhaps a 1-hour chart as well. This practice provides a much broader perspective on the market's behavior. It helps to confirm or invalidate signals that are observed on a single time frame. When employing the Fractal Reversal Divergence Technique, MTFA becomes key. Its role is central to effective application. A divergent signal appearing on a shorter time frame, like a 15-minute chart, might be minor. It could simply indicate a small pullback within a larger trend. However, if a similar divergence pattern also appears on a longer time frame, such as the daily chart, its significance increases dramatically. It suggests that a more substantial and meaningful trend change could be developing. This adds considerable weight to the observed signal. Traders often adopt a top-down approach with MTFA. They typically begin their analysis with a longer time frame. This helps them to identify the prevailing dominant trend. It also assists in pinpointing major divergent price territories, DPTs. Once this broader context is established, they then zoom into shorter time frames. On these shorter-term charts, they look for specific fractal reversal divergence signals. Crucially, these signals should align with the picture seen on the longer-term chart. This alignment is vital for identifying higher probability trading opportunities. Using MTFA effectively helps traders avoid analysis paralysis. This can occur from being overwhelmed by too much data on a single chart. It also serves as an excellent filter for false signals. A divergence signal on a 15-minute chart gains considerable strength. This happens if it is supported by the context of the hourly chart or the daily chart. The principle is to see the entire forest. One should not focus exclusively on the individual trees. This broader view generally leads to more sound trading decisions. Section 5. Degrees of fractal divergence enhancing signal strength. It is important to understand that not all divergent signals are created equal. Some divergent signals are inherently stronger and more reliable than others. The concept of degrees of fractal divergence helps traders classify these signals. A higher degree of divergence typically suggests a more robust and trustworthy signal. This classification system allows traders to prioritize their potential trade setups. They can focus their capital and attention on the most promising opportunities. This is a more efficient use of resources. A first-degree divergence might be a simple basic divergence. This could be an instance observed on just one time frame. A second-degree divergence would involve more confirming elements. For example, it could be a divergence that appears concurrently on multiple time frames. Or it might be a divergence that forms precisely within a very strong, well-established divergent price territory. The general rule is this: the more confirming factors present, the higher the assigned degree of divergence. It is like building a legal case. More pieces of evidence strengthen the argument. Let us consider a practical example to illustrate this. Imagine a bullish divergence signal appears on the 1-hour price chart. If this divergence occurs right at a major weekly support level, that support acts as a strong DPT. This confluence elevates the signal to a higher degree. Now suppose that, additionally, the 4-hour chart also shows clear signs of weakening bearish momentum. Perhaps an indicator is turning up. This would increase the degree of the divergence even further. This layering of signals builds a much stronger case for a potential upward reversal. Identifying these varying degrees of fractal divergence requires diligent observation. It also necessitates a clear and consistent set of rules. These rules must be predefined by the individual trader. By consciously focusing on higher degree fractal divergences, traders can potentially improve their win rates. They can also manage their trading risk more effectively. The underlying principle is to prioritize the quality of trade signals over the mere quantity of signals. This selective approach often leads to better long-term trading performance. Section 6. The fractal nature of markets. Why this technique works. The term fractal is absolutely central to this trading technique. Financial markets are frequently described by analysts as being fractal in nature. This essentially means that certain geometric patterns tend to repeat themselves. These recurring patterns are observable across many different scales or time frames. A specific pattern that you might see on a 5-minute chart can look remarkably similar to a pattern that unfolds on a daily chart, just larger. Consider the structure of a coastline. Its jagged, irregular pattern looks similar whether viewed from a great distance or up close. This inherent self-similarity is precisely what fractal reversal divergence aims to exploit. Reversal patterns, which are often signaled by divergence, can manifest as smaller fractal patterns. These smaller fractals can, in turn, exist as components within much larger fractal structures. Understanding this hierarchical relationship helps traders to anticipate potential turning points in the market. These turning points can range from minor price corrections within an ongoing trend, or they can be major significant changes in the primary trend direction. The scale of the fractal is important here. When a divergence occurs between price and an indicator, it typically suggests a breakdown. It signals a weakening in the momentum of the prevailing trend. If this divergence happens at a point where multiple fractal patterns appear to align or complete, the resulting signal is often stronger. For instance, imagine a small, short-term fractal reversal pattern. If this pattern forms exactly at the expected completion point of a larger, longer-term corrective wave, this confluence is powerful. Traders should pay close attention to such alignments. The fractal lens encourages traders to see beyond simple chart events. They learn to look past mere trendline breaks or basic indicator crossovers. It prompts them to search for patterns that exist within other patterns. This deeper, more nuanced understanding of market structure can significantly improve trade timing. It can also assist in setting more accurate and logical profit targets. Furthermore, it can help in placing more effective stop-loss orders. In essence, it adds a crucial structural dimension to the practice of divergence trading. Section 7. Strengths of fractal reversal divergence, the trader's edge. The technique of fractal reversal divergence offers several distinct strengths. These can provide a trader with a valuable edge in the markets. One of the major advantages is its potential for facilitating early entry into new moves. By identifying weakening momentum before a full trend reversal is obvious to everyone, traders can position themselves near the beginning of a new trend. This often translates into more favorable risk-reward ratios for their trades. Capturing a larger portion of a move is a key goal. Another significant strength of this technique is its remarkable adaptability. Fractal reversal divergence can be applied effectively across a wide variety of financial markets. This includes individual stocks, foreign exchange currency pairs, and broad commodity markets. It is also relevant in the newer domain of cryptocurrencies. Furthermore, it can be utilized on many different time frames. This versatility makes it suitable for various trading styles. Day traders focusing on intraday moves can use it. Swing traders holding positions for days or weeks can also benefit. Moreover, the application of fractal reversal divergence encourages a structured trading approach. It requires traders to meticulously identify divergent price territories. It also necessitates the consistent use of multi-time frame analysis. This inherent discipline in the process can help to reduce impulsive trading decisions. Such decisions are often driven by emotion rather than logic. The technique forces a more methodical and objective way of looking at price charts and evaluating potential trade setups. This builds good trading habits. Furthermore, when this divergence technique is combined with a solid understanding of fractal market patterns, it provides deeper market insight. It elevates analysis beyond simply watching an indicator cross a line. It becomes about understanding the underlying market structure. It involves deciphering subtle shifts in market sentiment and participant behavior. This more profound comprehension can lead to more confident trading decisions, and confident, well-reasoned decisions are often the ones that prove to be more successful in the long run. Section 8. Weaknesses and limitations, the importance of caution. Despite its notable strengths, fractal reversal divergence is not an infallible system. It is important for traders to be aware of its weaknesses and limitations. One significant weakness is that divergence can sometimes persist for an extended period. Price can continue to make new highs in an uptrend or new lows in a downtrend, even while divergence is clearly present on an indicator. This situation can lead to premature entries against the prevailing trend. Such early entries can result in losses if not managed with extreme care and proper stop losses. False signals are another legitimate concern with this technique. Not every instance of divergence will inevitably lead to a significant price reversal. Sometimes a divergence might only signal a minor consolidation phase, or it could merely indicate a brief pause before the existing trend resumes its original direction. This is precisely why obtaining confirmation from other indicators or patterns is so critically important. Relying solely on divergence as an entry signal is generally a very risky trading practice. It should be avoided. The interpretation of fractal patterns themselves and also of divergent price territories can sometimes be subjective. What one trader clearly sees as a key fractal pattern or a significant DPT, another trader might interpret differently or miss altogether. This inherent subjectivity can potentially lead to inconsistent trading results, especially for less experienced traders. Establishing clear, objective rules for identification and then consistently applying them helps to reduce this subjectivity over time. Experience also plays a big role here. Moreover, this trading technique demands a considerable amount of patience. High-probability trade setups, particularly those involving higher degree divergences with multiple confirming factors, may not occur very frequently. Traders need to cultivate the discipline to wait for these quality signals to appear. Impatience often leads to the temptation of forcing trades on weaker, lower quality setups. This behavior pattern commonly results in unnecessary losses and frustration. Discipline in execution is a cornerstone of successful trading. Section 9. Context and confirmation, the keys to successful application. It is strongly advised that fractal reversal divergence should not be used in isolation. The broader market context in which a signal appears is extremely important. Traders must ask, is the market currently in a strong unidirectional trending phase, or is it predominantly trading within a sideways range or consolidation pattern? Divergence signals generally tend to perform better and be more reliable in ranging markets. They also work well when they appear at the mature end of well-established trends, signaling exhaustion. Context provides the necessary backdrop for signal interpretation. Confirmation from other technical analysis tools is absolutely essential. This adds a layer of validation to any potential divergence signal. Such confirmation could come from classic candlestick patterns like an engulfing pattern or a doji. A clear break of a significant trend line can also serve as confirmation. Signals from moving averages, such as a crossover, can be valuable. Volume analysis showing increasing volume on a reversal attempt can also add weight. For example, a bearish divergence combined with a bearish engulfing candlestick pattern near a known resistance level is a much stronger signal. Effective risk management is also a critical and non-negotiable component. Even with multiple layers of confirmation, no trading technique can ever be 100% accurate. The market can always deliver surprises. Therefore, traders must always employ appropriate position sizing strategies. They must determine how much capital to risk on any single trade. Crucially, they must set and honor stop-loss orders for every trade undertaken. This practice protects their trading capital from unexpectedly large or adverse market moves. Being prepared for the unexpected is vital. In conclusion, fractal reversal divergence can be a genuinely powerful tool in a trader's arsenal. When applied correctly, it helps traders to identify potential market turning points. It can do so with a greater degree of precision than many other methods. When it is thoughtfully combined with multi-time frame analysis, the identification of divergent price territories, and robust confirmation from other well-chosen techniques, its potential for success increases significantly. Lasting success with this method lies in disciplined application, unwavering patience, and diligent, consistent risk management practices. If you found this video helpful, make sure to subscribe to the channel for more professional trading tutorials and market analysis. Got questions or topics you want us to cover? Drop your requests in the comments below. We love hearing from you. Thanks for watching, and until next time, trade smart and stay profitable.